All right. Good morning, everybody. CPI at 8:30 will provide the market with a glimpse of how tariffs may be impacting the rates and inflation and the projection of rates. Everybody has said all year that tariffs are inflationary, that inflation is going to rise. And while it's been sticky, it was sticky before the tariffs. And nations around the world have cut. We continue to not cut on the idea that these tariffs are going to cause inflation, and that if we cut, it would just overheat the economy and inflation would rise, and then we would need to raise rates again. So they kept them steady. That is a anticipatory behavior, and the Fed normally is a reactionary behavior. They see the data and then they respond. They don't anticipate data and then respond. But you can't prove a negative, right? If you've gone to college, you've worked through that logic before. You can't prove a negative. So, is inflation not rising because they didn't cut, or is inflation not rising because these tariffs, the way that they've been piecemealed and kicked out and taco and everything else, that they're just not raising rates, or they're just not, causing inflation? Remains to be seen. But this data is supposed to go to the heart of all of that. And so it is relevant to what's going to happen for the rest of the week. It's also OPEX this week, right? So, we have that to consider. So for today, markets are mostly flat. The call yesterday was that we would, sit and do nothing, hurry up and wait day, sideways day. And this morning we're getting more of the same, only up until 8:30, right? That's when we're likely to see everything change. And that is the concern at the moment. What to do, or what will happen after we get the CPI data. We're going to get some Fed members later in the morning, which, depending on what we get from CPI, what they say very likely isn't going to have any impact. It really just depends on what we get from CPI. A lot of people believe that this forecast is way off mark, right? They're looking for an acceleration. If it is less than 3, right? So 2.99, 2.95, anything less than 3.0, then markets are likely going to rejoice and everybody's going to be happy. If we get above 3, then we could see a little temper tantrum, some saltiness out there, and that will be the day, right? That entire thing is going to be the focus of today. Everything is going to come back to that CPI number today. This is the range that we're dealing with, right? Just kind of zoom in here. We are IX10 inside of this really big bar, and nobody cares because it's a really big bar. But we're also IX10 inside of this bar. Getting better, got my attention. At the moment, we're in this little bitty doji right here. If today wasn't CPI, say it was tomorrow, and we were going to go through another day of this sideways stuff, and we ended up tomorrow inside of a very narrow day like this. Right now, this is just inside day. Tomorrow would be an IX10 of a very narrow range. that would get my attention. That would be important. But if we use OCR style analysis and kind of back this up, this is compression, right? So we're getting smaller and smaller and smaller candles. We're forming a wedge in an OCR style price pattern. And when you compress markets, they will explode, right? Just like anything else in nature. You have to have a release valve and release the pressure or it pops. So that is not offering directional bias, right? We don't read that as bullish or bearish. We don't try to anticipate direction. Like a coiled spring, when you take your finger off of it and it just shoots across the room, you're not trying to anticipate which direction it's going to go. You just know it ain't going to stay here. Same thing with price. So collars, strangles, straddles, even, layering out targeted butterflies, something other than, hey, I bet we're going to still be here by the end of the week. Probably be a safe bet. We've seen that the call wall was rolled back up to its previous location. They didn't move it to a higher place. They just put it back where it was. So, if that's still there tomorrow, then that's going to tell us that we need the guardrails removed from OPEX to really go any higher from here or lower. The thing is, if the data is really good today, I think that it'll force them to move their call wall and put wall, and they'll do it because it's OPEX this week. What does it matter if they, move those positions 2 days early? In the grand scheme of things, nothing, right? If they get enough clarity today from CPI, I think they will be willing to go ahead and move the call wall and put wall a few days early. And that means there won't be any rails to hold us in place and price discovery can begin again. Who knows, right? GTFO, we got to get out of the box. So get out of the box. You can see we're on the 3-day moving average. It's what we've bounced on this morning with this little micro double bottom. The thing is, while the textbooks would call that a double bottom, I would call that an inverse cup and handle. The difference being that we have equal lows rather than an extended low. And for those who've been around for a while, you know that when it comes to double bottoms, it's supposed to be a bear trap. So I want it to extend lower than the previous low to actually trap those bears so that we get the forced buying on the spring back up. And it makes a really nice double bottom bear trap. Without that, we haven't tricked any bears. We don't get their forced buying to get out of the position. And instead we end up with like an inverse cup and handle where we bounce on the previous low, we run up into like a 786, and then we continue to move to the downside. That's my take on that. At the moment, we're just playing close of a liquidity gap here. It's a little itty bitty one, but it counts. The front run on 6,400, we're just waiting on data, right? But we are resting on that 3 or 4 period moving average. Got the 10 underneath. Really, everything's underneath. All the major moving averages are down below. Put wall's a long ways off. We would need to break last week's Friday low, right? It's not Friday of 2 days ago, but the week before that, the Friday low, to get to the put wall. It's a long ways off. Way out yonder, right? 62.20 area. It'd be really close to the 50 period daily moving average, which we would hold, right? If we did drop down that far, we would bounce on the 50. 62.32 cog line is where the 50 period daily moving average is. That'd be a really great first touch play. And if we break the 20 with gusto, that's where we're headed. But I mean, that's extreme, right? We're not looking to get, below 62.50 today unless things are just absolutely horrible in the news. So if CPI is that bad, then sure, if it comes in at like 3.5, we're going down like that Titanic. I mean, at first blush, you would think that, but it would force a cut, right? And that's what everybody's been wanting anyways, which is why I can't understand why the president freaked out over the job numbers that he got, because it's going to force the Fed to cut, which is what he wanted in the first place. So why fire the person that was offering them the data that he needed to force the Fed to give him a cut? I don't know. Doesn't make any sense. Markets can stay irrational longer than you can stay solvent, right? How about that? The market maker move, as I mentioned last week when we were in OPEX, you're liable to see that every single day of the OPEX week. So we know it's CPI this morning. But even if we didn't have CPI today, we very likely would still have seen the market maker move today because it's OPEX week. So, that's the bad thing about this indicator. And it's just the way that it is. You got to make do, nothing is perfect. The range that we have today with the ADRs, the lower one is inside, so we don't have to get a breakout to reach it. But to reach the bottom one, we would have to get an inside day breakout. $63.87.5. We'd have to expand beyond that and get to this lower ADR. Either one of them is on the table. We really don't have much edge. We're basically flat on the morning. We haven't gone closer to one than the other. Got a really narrow IB, and we've expanded outside of it, at least to the upside. And we came back in again. We got nothing, right? But narrow range days, or a narrow ranged initial balance, can lead to distribution, double distribution, trend days, and expansion. So we'll take it. I'll take it. Yeah, that's just a really wide weekly range pivot. That channel is massive. Today's floor pivot is slightly below yesterday's. It's down, so that's bearish. Price open underneath it. That's also bearish, but we've run up and hit it. We don't have an MDP, and we didn't get to keep the one that we had yesterday because we ran through it yesterday afternoon. If we break yesterday's low, 63.88, 63.70 is on the table with the weekly floor pivot. That's a really nice target, and it lines us up with Friday's Globex low. Basically Friday's low, right? All of Friday's low. Open, high, low, close pivots are valuable, useful, and that would be the target if we break yesterday's low, Friday's low. To get there, we would need to get through the RTH low of Friday. And of course, there's 63.92 cog line before we hit yesterday's low. And, there are things down here to hit, but Friday's RTH low, and then all of Friday's low lines us up with the weekly pivot point. And that's if we break yesterday's low. Everybody's all gloomy on this CPI report and looking to the downside, but don't mistake the idea that we have to go down, right? CPI does not have to come in hot, and if it doesn't, it's very likely that we're going to be at like 64.50, 64.75. You know what I mean? That we're going to get a nice solid push to the upside if this comes in, less than expected. Still building out the range that we talked about earlier in the week. We can see this distribution now extending for the third week, actually into the fourth week, because we were building it out here last week, and now this week. This is a major level that's getting a lot of work done to it. And to the downside, sure, we still have 63.50, but it's new, right? It wasn't there 2 weeks ago. They started building it out last week. And even back here a couple of weeks, which we're looking at because that point of control and a little bit of double distribution back here, it didn't help us out the following week when we ripped through that zone like it wasn't even there. So really it's just new work, 63.50, and I don't know how much that's really going to help. If 63.50 breaks, then 62.50 is on the table. We're running 50s, right? Remember, we're not running round numbers right now. So 63.50 to 62.50, that would be Friday's low area, or that last week's low area, whatever it was. You know. You can see what we've been talking about with the multiple weeks point of control. It is where we are at here with the 10-day, 30-minute volume profile and TPO. We've built it out really nice. There is nowhere else that we're going to go anytime soon. This thing is not going to move for weeks. So the idea is that we want to hover around it, continue to stay within it, and or expand above it. As long as we're just sitting here chopping above and below, then we can chop above and below, no problem. Should we cut a distance away from it, say we're cutting around here and we really cut down and then try to come back into it, it will act as a resistance. Of course, same is true the other way around. If we cut to the upside and then try to come back down into it, it will act supportive. It is the line in the sand at this point. All right, the point of control that we carried forward yesterday offered a lot of insight through the day. I don't know if you guys kept that level on or not, but it lined up well with the Globex low. We tested and got back above it in the RTH, and then when we finally did break through it, we buzzbeat off the bottom of it and then sent it all to the downside. We're still struggling with it today, really. I'm going to just leave it on there for a little while. It seems like we're not done with it. But we do have a VPOC today, so we want to add that. And that's the thing with these levels. There's no real guidance on when to take them off. And of course, if they haven't been hit yet, the base case is leave them on. But once they have been hit, you still got to ask, are they still relevant at this point? Do they still have any value? And you just have to judge that by the way price continues to respond at those levels. If price is running through it like crazy and there's absolutely no response, then yeah, get rid of it. But if you continue to see behavior at that level, it still has value. It would just be a POC level at that point, right? It's not a VPOC, but it would still have value to it. Like this one down here that I just carried over. It still has value. Really nice distribution this morning. Nothing stands out here for any sort of signal along the top or the bottom. It's just a really clean distribution, classic case. I mean, that's straight out of the textbooks. Right? You couldn't ask for something better. To have an entire day look like this would be, like a pinup poster for your classic distribution bell-shaped curve. Cheers on that, right? Everything we've done so far this week has been resting inside of Friday's range because it's supposed to be a sideways week while we wait on data. Surprise. In case you haven't heard yet, we're waiting on data. But once we get that data, 65.10 is the upper edge of the week's expected move. If CPI comes in soft today, that's the target. I know I said 64.75, but I didn't realize how close we were to the upper edge. 65.10 sounds good today, especially from a compression example like we have. But that's going to need CPI at like 2.8, right? Showing it's actually going down, or maybe holding the range 2.9. Maybe that would do it, but I don't think it will. I think we need to see it actually lighter. to get that sort of fuel. What is it, 1.21 gigawatts? Huh? Anybody old enough to know where that came from? We need some power. We're still above the 10-day, holding in the zone. This is exactly where we want to be if we're just digesting. Markets need to correct, and we can correct in time or we can correct in price. And I don't think anybody really wants to see the market sell off, so a correction in time is preferred. We're just sitting in the zone, nothing to see here. Everything's fine. For the weekly, come on, I ain't that old. Good God. We're still 2% above the 10-week. We've been carrying on since the lows back in March, early April. And while we peaked and we've been kind of fading back, everything's still fine here. There's nothing wrong with our position with the 10-week. We're not overbought. We're not oversold. We're not overextended. It doesn't owe us any sort of pullback or mean reversion at all. And because we're not extended like that, we have plenty of room to the upside that we could travel without still being overbought or oversold. We're good, right? There's just nothing wrong here. Not really expecting anything out of the market watch this morning. We're sideways waiting on data, and that's what I would expect out of most of the market. So Bitcoin is down 0.5%, barely, but it's there. And over a 5-day period, it was up more than 5% after giving a half back. We're up, a little more than 4.75%, but it's fine. It needed to rest, right? And then the Mag 7 up volume is down. Yeah, I know that's a little confusing. Bitcoin again. So yeah, Bitcoin and Mag 7 are down the most this morning, barely at 0.5% after making some pretty exaggerated moves in the last 5 days. Don't see anything wrong with that. On the other side of the fence, nothing other than some triple leveraged China ETF yen. And that's it. That's the only thing that's up this morning more than 0.5% because we're waiting on data, right? Surprise. In case you hadn't heard, we're waiting on data. Hey, y'all did really good. Nobody asked me yesterday if it was supposed to be a sideways day. Cheers, huh? Maybe we're getting the word out. Pot stocks are leading this morning, and you do not want markets led by pot stocks or solar stocks or commodities. That isn't just, it's not what you want, right? So we got pot stocks leading. Who cares? You don't want a rally day built on pot stocks. Well, that's the thing. If it's over 3, it's going to very likely force the Fed into considering rate cuts, right? So if it's high, isn't that going to give him what he wants? But I mean, jobs were high, and that would have given him what he wanted, and he fired the person over it. So I don't know. Nobody said it has to make sense. Crude's down, Bitcoin's down. Precious metals are moving to the negative side, but they're not down enough. And we are just waiting on data. So we're waiting on data. But look, today we have an opportunity for a liquidity gap play, right? This is one of my favorite trades in the pre-market. And while we can get this trade at any time, I like the idea that we know when it's going to hit. Right? It's kind of like, needing the electricity to strike at a very particular moment in time. How can you ever anticipate when you're going to get an electrical strike? But if you could harness it. Same thing with these liquidity gaps. They can happen at any point, like we had one yesterday afternoon, right? Let's put that on the right time frame. We had that reversal yesterday afternoon, caused a liquidity gap. So big pop up, that's the liquidity gap. And we came back down and got that gap closed. Why? Because it's a gap and markets want to close their gap. Same thing later in the afternoon, that's a liquidity gap. Markets tried to close it, didn't quite get it closed, and then down we went again. These are relatively small ones, right? These are like itty bitty baby ones, practice versions. Today, we're likely to get one of those in a much bigger form. It'll look a bit like this. This is a liquidity gap style candle. The half of that became relevant, and then finally we made it all the way back up and we closed the gap. It's likely to be bigger than that one. So when we get it, we're looking for a really big candle. We don't want any wick going in the other direction. This little doggy tail here, that's nothing. But we wouldn't want to see a really big wick up there, right? A little bitty one, that's fine. So no wick going in the other direction, and we want price to close in the lower 25 percentile, right? So if we cut this and say, well, that's 0, and then that's 50, and all the way down at the bottom, that's 100. There's 75, and then, there's 25. If it's headed to the downside, we want price to close in this area, in the last 25 percentile. We wouldn't want it to close, near the half, and certainly we don't want it to run all the way back up and close where it came from. That would defeat the purpose because, well, then what's the gap to close? We've already closed it. It could be the same thing if the candle was blue or green and it went to the upside, that we would want to see it close in the upper 75%, right? The top 25 of that candle. And eventually it would get a gap close. While we wait for it to close the gap, we can also measure the entire candle's range, mark its midpoint. And then if we didn't immediately start trying to retrace and close the gap, and we instead continue to expand in the direction of the candle, start marking out 50% and then 100% and 150 and 200, because we can use these candles to extrapolate the targets, right? 50%, 100% on down. Every single candle textbook talks about this. Unfortunately, they just brush through it like it's some oddity that, barely mentioned at all, but they all mention it, right? Thing is, candle books are so freaking boring. Nobody actually reads them. They just kind of skim through and look at the pretty pictures, and then they skip that detail. It's okay. I get it. So we are waiting on data, everybody. CPI data is supposed to provide clarity. I will add a little caveat here and say it doesn't have to. It's supposed to, but that doesn't mean we're actually going to get information today that solves the problem. A lot of times the data we get just muddies the water even more, and we have even less clarity than before we got the data. That's just the way it goes, right? So we would like to hope that we're going to get really insightful information today that gives us forward guidance, and we all get a plan afterwards. But that's what we hope. That doesn't mean that's actually what we're going to get. So we'll see how it goes. The main thing is watch the clock, and don't assume that the first push is going to be the actual direction that we go today. Right? That's what the liquidity gap concept is all about. So at the bare minimum, warn you, that just because you get a big green candle doesn't mean we're going to stay green all day, or a big red candle that we're going to be red all day. It could, but it doesn't mean we have to. Watch the clock. Be careful. Be safe. I'll see y'all tomorrow.